A potential war between Russia and Ukraine has put pressure on an already spooked stock market. What are the real personal financial implications of a foreign war? We explore that in this week's Fastest 4 Minutes in Finance. Hello once again, I'm Scott Inman. Well, Russia this week ordered troops to Ukraine, which has escalated worries about an invasion of that country and that war could follow. Russian President Vladimir Putin moved the troops into two Moscow-backed breakaway regions of Ukraine, declaring independence for those regions. The White House responded by issuing an executive order that restricts investments and trade in those regions and has now issued additional sanctions. We could be quick to think that since this is all happening half a world away, the impact to us could be minimal. And we might be right. The most likely impact will be at the gas pump. Germany announced it has taken measures to halt the process of certifying the Nord Stream 2 gas pipeline from Russia, and President Biden has laid out sanctions including blocking energy sales from Russia. Oil prices, as measured by U.S. and global benchmarks, are already near 7-year highs, not far from $100 per barrel. Many analysts believe those prices will continue to rise if war breaks out in Ukraine. Russia is also a big supplier of natural gas to Western Europe. Strain over that supply could be a contributor to higher prices as well. Now, as for stocks, the S&P 500 index is already down about 10% year to date. If war breaks out in Ukraine, the market could drop even lower initially. But those stocks might not stay down for long. Historically, if you continue to stick to your financial plan and have a long-term perspective, the global events that rattle markets don't rattle them for long. According to Ryan Dietrich, the chief market strategist at LPL Financial, measuring the market after geopolitical events over the past 30 years, the market was positive 6 months later, 71% of the time. Sam Stovall, chief investment strategist for CFRA Research, says the market on average shrugs off surprise military events or even terrorist attacks, dropping on average 5.5% over the length of the event, but needing on average just 52 days after that to recover losses. That's based on market reaction since World War II. Now, there's no doubt 2022 has already started off with lots of headwinds for the market: inflation, the likelihood of rising interest rates, and now a possible foreign war. But the U.S. economy remains on solid ground. Brian Westbury, the chief economist for First Trust Advisors, said in his weekly report that his firm is staying with their year-end fair value target on the S&P 500 of 5,250. That would represent about a 20% increase from where we are now. His reasoning: corporate profits are still rebounding big from the pandemic. Those numbers were up 19.7% in the third quarter of 2021 year over year, and 21.2% compared to pre-COVID peak at the end of 2019. Bottom line, there will always be a crisis that could make us think there's a reason not to invest. But sticking to your plan and not being swayed by short-term volatility has been the better way to reach your goals. Thanks for listening.